Hello. Yes, good evening, everybody. I hope you can hear my voice and also see my screen clearly. Today's webinar is going to be one very useful one. I must say that because in my experience, this is the only strategy that everyone should be looking at. One thing is this. I've tried looking at all the indicators that most of the indicators, like the one you see here, I've tried looking at them. I've tried looking at the accelerator. I've tried looking at the AD, ADX, whichever indicator, or whatever name you can call it here. I've tried putting all these indicators together, like to get the best strategy for entry. The best strategy for trading. But every time I pick an indicator, maybe I pick the Bollinger Bands and then I place it on my screen like this. Something always happens. The thing is, you'll find that the indicator tends to work for sometimes, and then there is a point that it has to lose. And if you check keenly, if you are just very, very careful, and then you say, okay, now let me focus properly on building an like a best indicator or an EA that is based on the Bollinger Bands. The result is that if you are using the same thing again and again, you'll find that you're winning almost 50% at a time. It's always around 50%. You'll get it 51 or maybe slightly below 50 or slightly above 50 or slightly below 50. So whichever indicator you choose to use here, whatever the name you may call it, whether it is bears, bulls, or whichever, this one, the result is always 50 to 50%. The result is always 50 to 50%. So you may think that you've found something which actually works very, very well, but you'll be surprised that the result normally is just 50 to 50%. So whatever, irrespective of whatever you're looking at, the result is always 50 to 50%. Okay, there's another thing which you have to understand, that assuming somebody's doing, you're trading based on the moving averages, not the Bollinger Bands now. You are using these moving averages. You go to insert indicators, and then moving average falls under moving average falls under trend indicator. So we go to trend, and then we go to moving average, put it there, and then you use a period of 10. Like this one here, this is a period of 10. So our idea here is when the price breaks below the moving average, we pick a sell. And then the price breaks above this moving average, we pick a buy. So that's simple. Let me tell you something. If you follow this strictly, from whichever time frame, whatever you're looking at, whether it's 15 minutes chart, 30 minutes chart, or 1 hour chart, or even 4-hour chart, the result is always the same. You'll find that you are winning actually 50 or slightly below 50 or slightly above 50%. And you are losing also slightly above 50 and or maybe slightly below 50. Okay, that's when the period is 10. If you increase this period, assuming you now say, okay, let me put 80, you'll be surprised that the results is still the same. So if you now say that if the price breaks below this point, it continues down. If it breaks above, it continues up. You'll be surprised to find that the results is still just the same. It's still 50% win rate, around slightly above 50 or slightly below 50. You'll still find that you are winning around that amount. So if you find, for example, assuming you're doing 1 hour, then you all of a sudden find that when the price breaks above, the winning rate is slightly higher, then try to increase the amount of data you are backtesting. The more you backtest, the more it settles at 50. This is from real life experience. The more you try to backtest, the more it settles at 50. So this is one main thing you need to understand first of all, because whatever I'm going to say about risk management depends on you understanding whatever I'm saying. Okay. There's something else. Now I started asking myself, how comes like all the indicators, whether I use the MACD, whether I use whichever indicator, AMA, whether I use the ADX, if I just followed the same procedure, the result is just 50 to 50%. So I started asking myself exactly what gives one an edge, so that I'm able to earn maybe 60% or 70% at a time, not just 50 or slightly below 50. Okay, the result is very simple. I mean, the finding is very, very simple. Every indicator, whichever indicator, whatever name you call it, wherever you get it, the result is always around 50. Don't be deceived. So depending on how much data somebody's back testing in the past, you'll find that the result is always 50. If you put more data, if you start back testing, the longer the more back test, the more you find that it's just 50. Especially this indicators, the one you have, the standard indicators you have on MT4, MT5. You'll find that each one of these, the result is always 50 to 50% win rate. Okay, now, as I was saying, I started asking myself, how can I increase this win rate so that I'm able to win maybe 60 to 70% or even 80%? The result is simple. The finding is extremely simple. You must learn how to control your risk. That's the answer. It is how well you are managing your risk that you will be able to increase your earnings. That's when you'll be able to increase your win rate. Because let me tell you something. You must have realized this by now that anytime you enter trade, maybe you enter buy here or you enter sell here, something normally happens. It's never a guarantee. However good your strategy is, it's always never a guarantee that when you enter trade based on a given strategy or an indicator, it's going to go that direction. It's always 50%. So whatever you are looking at, but whether somebody understands how to trade very well, somebody do not understand how. When you come into the market, your result is 50%. You will always find that you are not sure it's 50%. If somebody comes here, maybe this is the price. If somebody does not know how to trade very well, they'll probably sell it because the price is going down. If somebody knows how to trade very well, maybe you could have reasoned that this is support, then he took the buy. The buy failed terribly, while the guy who didn't know anything actually took the sell. So that means one thing, that it is exactly 50 to 50% win. There is nothing to it. There is no holy grail. There is no such thing which you can say that now if I know this, I now know everything. No. The only thing that if you know you may be having an edge is if you know how to control your risk. You must know exactly when to step out of a winning trade, when to step out of a losing trade, and when not to enter anything, or when to try and. This is your balance. You'll find your balance. Whatever balance you have, this is your balance. You'll find the equity here. You'll find the free margin here. So anytime before you enter any given position, understand that your money is safe as long as you've not opened a position. It's extremely safe, very safe, as long as there's no position running here. But when you come here and then you enter trade, that trade instantly begins to affect whatever you have, the equity, and ultimately the balance when the trade is closed. So before most newbie traders, or most of us, if I can say so, where you need to focus mostly on how much am I willing to give to the market. So that's, don't get deceived. Don't get deceived. Learning how much to risk in a trade is way much more important than even the strategy itself. Because the strategy may be saying a sell or a buy, but it is the balance which gets affected as a result of the strategy. So how much you are risking on any given trade is extremely important, because it affects your how long you're going to stick to trading. Does that make sense? Before you enter any position, the first thing you want to do is to understand very well that this is the amount I'm willing to risk. This is how much I'm willing to risk. So when you know how much you're willing to risk, then now you can go ahead and then enter the position. And when you enter a position, you're not just entering the position because anything is happening. Enter the position in a way that you also know, in a worst case, how do you step out. So that brings us to the stop loss. Okay, for the stop loss, there's one thing which I recommend you use. Use the zigzag indicator for the stop loss. Okay, you'll find the zigzag here. That's the second. It's amongst this list of indicators. You'll find it here. So when you go to the navigator, there is the indicator button. You click it, and then it will take you to where you have this. So you'll click that, and it is this that will pop on your screen. So one thing is this: you're going to risk is the most important thing that you're supposed to focus on. So understand very well that before you enter any position, whatever you're putting at risk is actually your balance. So your balance is as safe as possible as long as there is no open position. But if you go ahead and open any position, whether it's a volume of 0.01 or 1 point something or even 10 point something, it is then that the volume becomes affected. So we do have an indicator which I use, as I was saying, an indicator which I use for stop losses. So it's the zigzag indicator. I use the standard setting. So the zigzag indicator comes by default on any MT5 platform. So it's here, the depth should be 12, deviation should be 5, and then back step should be 3. The color, I want to make it black so that it's much more visible. And then I'll give it a larger width of 2. So we have it here. This is how I use this indicator. You can see here that the price is bearish. We are heading downwards, downwards, downwards. And the price starts to move to the upper side. So when the price breaks above this top here, that's when this candle here, when the price breaks above that top, I pick a buy position, and then I have my stop loss below this low here. That means that the way I enter here, the stop loss is very far. If the price continues to move up, it keeps giving us higher low, higher low, higher low, and even higher low, higher low, and even more higher lows. So I'll pick a buy position here, and then my first stop loss is somewhere here. Make this red so that you're able to see it clearly. So my stop loss is there. As the price now progresses to the future, I drag my stop loss below this low, below this low, below this low here, below this low, below this low, below this low, below this low. And as it continues to the future, you can see that the price actually went down and took my stop loss. So basically, this is how I do enter positions. So there is one thing. If you want to trade successfully, the amount of volume which you choose to put here, the volume is this one here. The amount of lot size or volume that you apply here should be related to the distance you are risking. Because if for example, the lot size is 1 and you have a volume of maybe, you have like a balance of maybe 1,000, you have here 1 and the stop loss is here. Then if the price moves maybe from that point up to somewhere around this point here, it will be margin called. That means the trade may likely also stop out. So you want that when you enter position here, the stop loss which you are having here, calculate your lot size in a way that it is directly based on a percentage of how much you want to risk here. The percentage, like maybe you want to risk 10% of this amount, and the distance between this and this. So if you do that calculation correctly, you'll find that you are risking something in proportion to how much you expect to be losing from your account. So maybe you say I want to risk 10% of this account. You don't know how to get the correct volume, so that if the price moves against you, you are still risking 10%. You need to learn that from our previous webinar. We actually indicated, we gave a very good formula on a way that you can enter position here and say that I want to risk just 10% of my account. And then you find the distance between this point and this point. Then you put all those information together. That's, you put how much you want to risk, the distance, and then you use that to get the volume, the correct volume. So the volume may not necessarily be 1. This means that your volume will keep changing. It will keep changing. It will keep shifting. Keep changing from one volume to another, one volume to another. So that's a very good way to have your stop loss. So the other thing is, if you pick a sell here, the reverse is the same. You'll have your stop loss. Like if you come and pick a sell, when the price breaks below this low, your stop loss will now be here. And this stop loss, you put it in a way that it's just a percentage of this account, a fixed percent. So you'll risk maybe 10% of your account on every trade. It's just 10% you're risking. Every trade is just 10% you're risking. Does that make sense? Okay. So I hope that should build way much more on what we looked at previously, to stress the fact that it's the risk, how much you are risking, that's the most important. It's not how much you have in your account, it's not which strategy you're using, it's not even where the indicator you're using is coming from. The most important thing is how well you're managing your risk. So as I've said, calculate how much you expect to risk in percentage of your balance, and then not the balance, actually the equity, and then calculate the distance between the point of entry and then the stop loss, find the distance in number of pips, and then use those two information to find out what's the correct lot size. So if you check our previous webinar on risk management, you should be able to understand exactly how the formula, you'll get the formula in one of our webinars, you'll get the formula on how to do that. So thank you very much. This should bring us to the end of today's webinar. We'll meet again next week at the same time. Thank you and see you.